Hello, I'm Ed Parrott. Welcome to Knoxville Real Estate Weekly. Well, this week it was no surprise to anyone that interest rates on mortgages continue to climb. So let's dig into the numbers and see if we can determine why they're continuing to climb and if there's any hope on the horizon for any relief. First of all, let's take a look at the labor situation. The first thing we'll take a look at here is the JOLTS report from the Bureau of Labor Statistics. This stands for the Jobs Opening and Labor Turnover Summary. And it came in stronger than expected this past month, which was a bad thing because that drove up the bond prices, which in turn drove up mortgage rates. The month-over-month increase in the number of jobs openings was 0.8%, bringing it up to 9.6 million open jobs. Now bear in mind, these are advertised jobs, so they don't become a real job until somebody is actually in the position doing the work. Now the hiring rate last month was 3.7% and the separation rate was 3.6%. So this is of course composed of retirees, just plain quit, or got fired or laid off. Now, there's only 0.1 difference between the two, and that indicates that the number of employees remained relatively constant. And if we look at the numbers from the BLS jobs report that came out on Friday, that verifies that it was at 167,000 new jobs for the month in the private sector. And that's down significantly from the 450,000 back in June we had. It varies a little bit from the ADP report, and they came in at 87,000 new jobs in the private sector. Personally, I tend to trust the ADP number a little more than the BLS number for the simple reason that ADP is a data processing company. They do payroll for corporations all over the U.S., and their report they put out in collaboration with Stanford University. Now, the one thing to be concerned about with the JOLTS report, however, is in fact the 9.6 million open jobs, because that means employers are going to have to compete more heavily to attract good employees, which in turn is going to put upward pressure on wages. Now, I've seen several reports that claim that wages don't affect the inflation. But that I don't think holds true for the simple reason if wages increase, there's only two things that are going to happen. Either number one, prices are going to go up to cover the increased cost to the employer, or number two, productivity is going to have to increase. So each individual employee is going to be putting out more work. That will allow the employer to reduce their labor force, because employers, no matter what size, I don't care if it's a small business with 5 employees or a big corporation with 20,000 employees or more, they're in it to make a profit, and that is the American way. That is capitalism. That's what made this country great. So you start raising their cost, they're going to raise their price or increase productivity and cut down on the number of employees that they actually have. Moving on from the employment situation to actual inflation, we take a look at the headline inflation, and that dropped to 3.7% last month, which is good, but the Fed doesn't really pay a whole lot of attention to headline inflation for the simple reason they don't feel they can control it. And as I said before, if they thought they could control it, you can guarantee they would give it a shot. However, at the same time, headline inflation dropped to 3.7%, core inflation increased to 4.3%, and that is what the Fed watches. And that means that they're not going to be in any hurry to either stabilize or certainly not start reducing the Fed funds target rate. The next inflation report will be coming out on October the 12th, which is next Thursday. So it'll be interesting to see what the two numbers do there, both the core inflation and the headline inflation. Now, why did the headline inflation go down so much when core inflation went up? One simple answer: the cost of energy. A week and a half, 2 weeks ago, oil was pushing hard on $100 a barrel. I mean pushing hard. It was right up there like $97 a barrel. One report came out which took the pressure off of oil, and that was the inventory level for gasoline in the United States. Right now, the level is 1% above the 5-year average for this time of year, which indicates people are in fact driving less, trying to save a little money. And here in Knoxville, we don't have it too bad. I spend about $50 to fill up my tank, which is bad enough, especially compared to the $25 it was cost. Well, it was about $32, I guess, at the beginning of this administration. Other places with much higher prices are spending significantly more to fill up their tank. I saw one news report, a gentleman out in California said he had scraped together $10 to put in the tank, which got him just under 2 gallons. He indicated that he was not driving anywhere he did not absolutely have to drive. And filling up his tank, he said, would have been a little bit over $100. So the fact that the oil or the gasoline inventory has gone up, that alleviated the pressure on oil, and it's backed off that $100 number. And as of the last I looked a couple of days ago, it was down to $85 a barrel. Now, another thing that's going to put pressure on the price of oil is the amount of driving traditionally decreases in the winter, so demand is going to go down even more, and that should bring the price of oil on down a little bit more, and hopefully the price of gas. So that brings me to one of my favorite subjects, the Fed. The next meeting for the Federal Open Markets Committee is October 31st and November 1st. Of course, they'll be making their announcement on November the 1st. Almost everybody, myself included, is expecting to see an increase in their target rate for Fed funds going up 25 basis points. Right now, their target is 5.25% to 5.5%. So we're all expecting to see that target bumped up to 5.5 to 5.75. So with that, we can't expect the Fed to lower the rates anytime soon. In fact, the talk has been to keep the rates higher longer. So at this point, it's looking to be like it's going to be at least a year before we see any real relief on rates. But we've had concerning statements from a number of members of the board. Of course, Jerome Powell is well known for being on record as favoring higher and longer. Of particular concern to me is Neel Kashkari. He's the Fed president up in Minneapolis. He has been quoted as saying that he is concerned that we may have to increase interest rates significantly in order to make any meaningful impact on inflation. So while there are a few moderate voices in the Fed, overall, they remain very hawkish on interest rates. So with that being said, let's move on and take a look at the actual mortgage rates. On Thursday, we set yet another 23-year high for the 30-year average mortgage rate. It came in at 7.74%. A year ago, it was 6.65%, so in the one-year time span, we've had an increase of 1.09% on the 30-year mortgage rate. The previous high was on September the 27th, and that came in at 7.65%. The low in recent times has been back in February of this year, and that came in at 5.99%. So rates are high. They're going to be high for quite some time, in my opinion, at least a year now. A couple of weeks ago, I was hoping they might come down in 9 months, but that's looking very much less likely at this point. So they're high. We just got to ride it out and see what happens in the future. But even with the interest rates being so high, is it a bad time to buy a house? Well, yes, it's a bad time, and no, it's not a bad time. The bad time is the fact that housing prices themselves are at record highs, and also the interest rates are at record highs. Therefore, your payment is going to be high. However, I spoke last week about the downside of waiting, and you can go back and take a quick look at, I've got the chapters marked, so you should be able to find it pretty quickly in last week's report. So there is the cost of waiting, and prices, although they're at a record high, I'm expecting they're going to level out for a while, and they may even recede for a little bit. But in the long term, prices will continue to go up. So you can buy now at a high price or buy later at a higher price. And the other thing to consider is there are financial benefits. And let me say, I am not a financial advisor, but it's pretty widely understood that the financial benefits include being able to deduct the mortgage interest from your federal income tax, as well as your property tax from the federal income tax. Also, as I mentioned, long-term prices are going to be going up, so you will be getting a increase in your equity just over time from the increase in prices. And lastly, you're paying into your equity at this point instead of paying somebody else's equity by paying rent. So my point being, if you plan to buy a house, you might as well go ahead and buy it. Now, the other thing you can do, as I said, it's going to be a year, 2 years, maybe 3 years before rates come down to the point where it would make financial sense, given closing costs, etc., to refinance. But eventually the rates will come down also, I feel. So I'd like to close out today with a look at the Knoxville market in particular. And I see a couple of encouraging signs there. One sign is the fact that the number of listings that are active at the end of September was 4,121. Now, while this is down slightly from a year ago, it is showing an upward trend. Now, I will grant that the inventory does tend to climb in the winter, but the other thing that I take note of is previously days on market were 30, and into September, days on market were 33. Now, that's a small increase, but it's an increase, and as properties stay on the market longer, that does put pressure on sellers. And we're noticing that in the number of price reductions. We're seeing a very significant number of price reductions. As a matter of fact, sales price compared with the original listing price right now is standing about 94%. And sales price compared to the current listing price is standing about 96%. So we can also note from those numbers that the bidding wars are pretty well over. It's getting more common to see deals with only a single offer. So 3, 4, and 5 offers per deal is becoming very rare. So that's all I've got for this week. Let's continue to hang on. It's a wild ride, as we said, but that Bronco's got to get broken sooner or later. So thanks for stopping in. I appreciate your watching. If you got good information out of this broadcast, please like and subscribe to the channel, and be sure to click the notification bell so you'll get notified whenever I put out any new content. So thanks a lot. Have a great week, and let's see what the inflation report says next week.